Welcome, Hilo, and aloha. Welcome to the very first Hinesight Insight session. Why am I doing it? Well, I live here at Hilo. I've been here 12 years, been coming a long time, and I brought something I have in my bag of tools, a planning system called HinsightFinancial.com. It's a website, but it's a teacher. And why do we need it? Well, there's some myths on the street, and I'm here to break those myths, and I'm going to shatter the whole thing, because what we are doing is transferring wealth unnecessarily. And when you give away $1, you don't just give away the dollar, you're giving away the interest on that dollar for the rest of your life and your children's life. And we need a better life here in Hilo. So if we make our model more efficient, instead of trying to make it a little more risky, and isn't that the answer all the time? And risk is not necessary. There are other ways to safely save for college, for retirement. And that's why I want to talk to you about this. Let's talk about something that everyone knows. That a mortgage. And you'll say, what am I talking about a mortgage? Well, I'm going to talk about every financial product that you own. But let's talk about mortgages, because more money is transferred unnecessarily and unknowingly in mortgages than any other product we buy in this country. That's number one. They're doing a great job of teaching us how to transfer unnecessary wealth to the banks. Which money? Well, I got a piece of real upsetting news for you guys. The 15-year mortgage is the most profitable for the bank. Yeah. Why? I'll give you the concept. You're transferring unnecessarily wealth. Let's give two examples. One, we have a 30-year fixed mortgage at 6%. The payment will be $600 a month and $7,200 a year. We could go to any mortgage calculator and we could come up with it. Now, a 6% 15-year mortgage of $100,000, but by the way, they were both 100, is $845 a month. $245 got transferred that wasn't necessarily the right decision. The bank now has your $245 and they are now receiving interest on it. How about if you had held the $245, put it into a nice 4 or 5% tax-free account? Yes, you heard me. Tax-free account. And when you had all of the money, that's when you offer it to the bank. Now you have the money to pay the loan if you become disabled, if you lose your job, and how many people unnecessarily lost their homes in the '08 and many other times because of poor planning and bad advice. So let's talk about that. And I want to talk about one more, term insurance. I did a few calculations. Everybody says term insurance, you're renting the apartment, and I hope in your policy you have the option to buy, because the conversion of a term is necessary if you become uninsurable. You can't buy it again. You better be with the company you want to be with. But here's an example of a term premium, and they are cheap. Okay? If we were paying $1,200 a year for our term insurance from the age of 30 to 60, and we had access to putting that money into a 5% account, but we're not. We're giving it into an insurance company who's getting the interest on our money. And by the way, only 1% of all the term insurance in the United States over the past 40 years has death benefit been paid for. 1%. Yeah. So we're going to break a few of these myths. This is not cheap insurance. Matter of fact, this is how expensive it is. By the time you reach 60, you would have spent $83,712. Now that is your $1,200 a premium had it been put into a 5% tax-free account. And that is possible, so therefore it was a lost opportunity for you. $83,712. But then you only cancel the policy at 60. Yeah, you stop the premium. But the $83,000 now is calculating to the day you die as to an expense. And if you live to 90, and you probably will if you're about age 30 now, well, you're going to have spent $361,798 to rent a policy that you canceled 30 years earlier and no death benefit. And I thought term insurance was cheap. Well, I got news for you. It isn't, and it's renting, and you will receive no benefit like auto insurance unless you crash. So, let's not be doing things like that. Let's not rent insurance for the period of time when we're not supposed to die, and let the insurance companies off the hook when we are going to die. So that's what I'm here for, Hilo. And the next step I want to talk about is integration and coordination. We all have different people in our world. Our attorneys, our mortgage broker, our HR department at work, our accountant. Maybe we have an advisor of some sort. Well, I'll ask you this question. When was the last time those advisors got together to make sure they're all on the right page? I bet it's never happened. And it's not necessary that they all go into the same room. But the process at HinsightFinancial.com is 30 years. We integrate the policies that other advisors have into your model. Make sure there is coordination. We make it integrated and it becomes efficient and we lose less lost opportunity costs. So the recovery process is just that. So give me a call, 808-209-6263. Meet me in person or go to the website, Hinesight Financial.com. Look at one of the life events, click on those videos and learn. And I hope to hear from you afterwards. Aloha, hilo, let's get smart. Hinesight Insight. We'll be there.